When we look at the two-way analysis of total factory overhead variance using our Schmidt company numbers. So we've taken the four-way analysis that is in the top row and we've reduced it to two variances. When we're looking at variance analysis as a whole, an unfavorable overhead variance has a credit balance and a favorable overhead variance has a debit balance. So when we look at the standard cost variances for our Schmidt company, we have our direct materials and direct labor variances from chapter 14, and now we've added our four overhead variances from chapter 15. When we look at an income statement for those cost variances, we see that we had a selling price variance. So we had our sales at our standard selling price. We had a selling variance that was favorable. So we sold our items for more than we actually budgeted or our standard price was. So our net sales at the actual selling price was higher than our sales at the standard price. Our cost of goods sold at the standard price of $520 per unit, then we had an unfavorable cost variance. So that unfavorable cost variance is built out of these variances. So our direct materials variances, direct labor variances, and our overhead variances all add together to a total cost variance of $37,000 for manufacturing. That ends up in our cost of goods sold, which then changes our gross margin for our income statement. The other option is that if that total variance, that 37,000 variance, is considered material, we should allocate it or prorate it across work in process inventory, finished goods inventory, and cost of goods sold instead of putting it all in cost of goods sold. Our allocation should be based on relative amount of our standard cost in the end of period balance in each affected account. And we want to make sure for external reporting purposes that we're following FASB rules regarding the treatment of abnormal amounts. And this is our idle capacity expense. So we have to look at how much of this was based on just poor standards for cost setting and how much of it was just true rate variances from outside expenses. But we always want to investigate our variances and figure out what they were caused by. The effects on absorption costing change based on our denominator level choice for allocating fixed overhead costs. So our denominator level choice is based on what we predict capacity is going to be. We can, with absorption costing and choose of choice of our fixed overhead cost allocation, we can manage or smooth our reported earnings. So this is related to our ability to change our production volume variance. Because it changes the amount of fixed overhead cost that gets absorbed into inventory or releases expense on the cost of goods sold. So if the production volume variance is completely written off to the cost of goods sold, this can create income manipulation. We can also create income manipulation just from the volume of production that we do. And we'll look at this further when we talk about absorption versus variable costing in chapter 18. We can also use standard costing in service organizations. So any job with a repetitive task can use efficiency measures for. Even if we're non-manufacturing, we still have a relationship. We can have a relationship between direct labor hours and our output. So we can look at the kind of things that we might have in service organizations. So for example, an airline might look at passenger miles, and a hospital would look at patient days, hotel at occupancy rates. Any service firms such as accounting or legal firms would be professional staff hours. Colleges and universities use the number of credit hours, and K through 12 schools can use number of students. So this is a way to look at the efficiency measures and standard cost measures in service firms. We can also do overhead cost variances in activity-based costing systems. When we look at activity-based costing systems, we have multiple rates based on our activities. So in this example, we would have extra, instead of just having fixed overhead and variable overhead, instead we have our activity rates based analysis. So we would look at what are our flexible budget variances based on each one of our activity rates. So what is our application rate? The measurement is still the same. We just have, instead of fixed overhead and variable overhead, we have activity rates. There are also other types of accounting methods that are used in some areas. So we have a detailed German cost accounting system that is called GPK. And this is a flexible standard costing system that goes beyond the standard costing systems that we use here. We also have RCA, which is a resource consumption accounting. This is a cross between the German cost accounting system and activity-based accounting. So both of these accounting systems have large numbers of cost centers and cost pools, where in activity-based costing, we might look at 3 to 5 activity rates in some of these examples. With these other two methods, with GPK and RCA, we would actually we could have up to 20 different cost centers and cost pools. These are much easier to use if we have highly routine and repetitive operations. So robotic manufacturing, where we have machines doing a lot of the work, and we can compare activities. So remember that all of this allocation is looking at things that are very repetitive. So it's hard to do a variance analysis and some of these different cost analysis if our activities are very unique and our products take different hours of production across products for various reasons because of individualism and stuff. Then we would revert to job costing. So what we're looking at here are things that can be used with process costing and manufacturing costing, activity-based costing, or these other higher level costing methods. Once we've done all of our variance analysis, we've looked at chapter 14 and chapter 15, we want to know which variances do we investigate? Do we take all of the time and energy to investigate every single variance? Do we only look at unfavorable variances? Or do we have a standard amount that makes us investigate a variance? We shouldn't only look at unfavorable variances, because favorable variances don't always mean good things. And favorable variances in one location can create an unfavorable variance in another. For example, a favorable direct materials price variance can create an unfavorable efficiency variance and unfavorable labor variances if the main reason that the price variance was good was because of a lower quality. So it can't just be unfavorable or favorable variances. So many companies will set a threshold dollar amount or percentage amount and say if the variance is above this amount or this percentage, then we're going to investigate those. Otherwise, we just factor it in as a variance that's a normal business activity. We have different things that cause variances. So an uncontrollable variance that we can't really do anything about is caused by a random error. And some of that randomness can just be we couldn't predict that a natural disaster was going to occur, or we couldn't predict that there was going to be a shortage in a product that was going to lead to cost overruns, something like that. But controllable variances are things from prediction errors, modeling errors, measurement errors, and implementation errors. So do our standard costs need to be adjusted? Was our static budget good from the get-go? Were we doing good forecast modeling when we were creating our budget? Or were we just really off on our budget because we had a modeling error? Were we off on our standard measurements? Was there some kind of budgetary slack that was built in that created a greater variance because we had the budgetary slack built in? So all of those are controllable variances or variances that can be looked at that were caused by operational issues or management issues that can be corrected. If we're trying to distinguish between what is a random variance versus what is a systemic cost variance, we can look at control charts. So this can help us to identify when we have variations that should be investigated and can give us warning signals when we're way beyond a specified level. So what are those really big variances? For example, there's a control chart on the next thing where we've looked at warning signals for investigation. So where we've had variables that don't fall within a certain threshold. So in this example, we have some that are high and some that are low. And we would want to look at those outliers instead of the ones within a normal range of business activity. If we're under uncertainty, then we need to look at what is the cost of an investigation and the cost to correct a variance versus the present value of losses by not correcting the variance. So in this example, we would try to decide whether or not we're going to investigate or not investigate based on the time and energy it takes us to investigate and the level of what the variance looks like. So we would set the two equations to equal and solve for this indifference probability. So that's the at what point does it matter whether we investigate or not? So this gives us this expected value of perfect information. So we know that there's really no such thing for perfect information, and yet we still try to create perfect information. But there becomes a point where the cost of trying to generate that perfect information far outweighs any benefit of having that perfect information. So this is a way to investigate if we're under uncertainty in our business. That is the end of